चलिए boss, चलिए. So everyone in the class, very welcome to this session. Welcome to third lecture of CA Final AFM Full English Power Batch for the attempt of Jan 26 and onwards. So great, all the live people, very good morning. All the recorded people, welcome to you all as well. Very good morning. Join in. Someone please validate, confirm if you can properly see me, hear me. Is everything all right? Come on, people. Please tell me. Is everything all right? Superset? Yes. Am I clearly audible, visible? What is happening? Very good morning, everyone. Aksa is here, Anuka is here, other live people, say hi so that I can get to know who all do I have in the class today. Come on. So tell me, did you get a chance to look at the things that we had learnt yesterday? Did you get a chance to revise the things we had learnt yesterday? Super quick, come on. 1 second, let me put this on silent. One second, people. I'll have to. Hello. All right. So sorry, people. Yes. So let's figure out how strong has been your imagination. How strong is your imagination today? Let's figure out how impactful the OutNotes have been. Shall we try to revise the AFM without looking at the OutNotes in our imagination? How many of you are in for this? Come on, people. How many of you are in for this? So let's check at least if this technique of pictorial image, pictorial memory on which the entire OutNotes are based, is that working out? So let's take it one by one. How many of you are able to imagine the page of valuation where so obviously this is a risk I'm taking right now. Why? Because you don't have a soft copy with you in a downloaded form. You don't have a hard copy of OutNotes, right? All you have seen is on my screen only. Despite that, I want to check if you are able to imagine those things or not. Obviously, when you have a hard copy, the imagination becomes further better because you are able to imagine that, okay, on the left hand side, on the top was this topic, on the right bottom was this topic, this explanation was out here. I understand you don't have all those things, but at least try to imagine if you are able to, try to figure out if you are able to imagine those particular topics. How many of you are able to imagine that particular diagram where we learned the growth in EPS and growth in DPS, how are they related to each other? Come on. Let's check if you are able to imagine it or not. Soumya, Soumya, can you please send to me a WhatsApp for this? In the description of this YouTube video, Soumya, you will find my WhatsApp number, mobile number, which works on WhatsApp. So you WhatsApp me, I'll respond to you over there. Fine? Done. So are you able to imagine that page? Just imagine, I'm not asking for a solution, for an answer. Yes? Are you able to imagine that, sir, between 2 points, if the payout ratio is same, then the growth in EPS is equal to the growth in DPS. Yes? Are you able to imagine this? Then in the next slot, are you able to imagine if the payout ratio of this point and the payout ratio of this point are not same, then growth of EPS will not be the same as growth of DPS. In fact, I should say it otherwise, the growth of DPS will not be same as the growth of EPS. Come on. Were you able to imagine this? Were you also able to imagine that, sir, in such situation, the growth of DPS that I have to calculate, I cannot calculate it directly. I will have to first calculate the growth in EPS, and that grown up EPS, I will have to multiply the payout ratio to find out the amount of DPS, everyone, is what I'm trying to ask. So let's talk about the next thing. Are you able to imagine the variable growth model? Come on, people, the variable growth model. What do we say? Are you able to imagine in your brains a timeline? Are you able to imagine a point at the end of which, if I stand and look at the future, I have a constant forever growth rate? And are you able to imagine that we have to stand on that point to calculate the terminal value? That terminal value will have the present value of all future dividends. If I calculate TV at 3, the future value, future dividends means right from dividend of 4th year till the dividend of infinity, all those dividends can be discounted back in TV3. So now I realize that, sir, I have TV3. I have dividend of 3rd year, also the dividend of first 2 years. If I discount back these 4 cash flows, dividend of 1, dividend of 2, dividend of 3 along with the terminal value of 3, if I discount back everything, I get my value, intrinsic value. Please respond to me, all the live and recorded people in the class. Are you able to imagine that particular thing in your brains? Is it working out really or not? Come on, people. Dhananjay, is it working? Aksa, it's working. Also, are you all able to imagine alternative 2? Sir, I imagine that at the end of 3rd year I should stand, because since then all the growths, like for all the dividends, have been growing at a constant rate, but I know as per Gordon's, I can stand a year prior to that. Prior to that point, 1 year prior to that point, I can stand and calculate my terminal value, and that was my second alternative. Right? So anyway, super ultra fast. Now we will further speed up as we proceed ahead. Everyone in the class, let's learn. This was the chart we were first trying to imagine. Then the next thing we tried to imagine was this particular thing. Alright. Then we tried to imagine was alternative 2, where we see that the growth is constant from this point, but we stand a year prior to that. And then we calculate the terminal value. Then we had in the class yesterday solved a question where you learnt a particular thing. What was that particular thing in question number 21? The particular thing was, sir, whenever there is a change in payout, they say whenever the earnings growth rate will fall, then the payout will increase. Whenever there is a change in payout, you have to apply alternative 2. Alternative 2 says that don't think of EPS growth, think of DPS growth. Wherever there is DPS growth changing and becoming constant forever, stand on that point, come a year prior to that, apply terminal value calculation. That's what you learnt in question number 21. We also learnt that we will have to also create EPS column and payout column, because directly using the dividend column we won't be able to find out the final dividend needed for terminal value calculation. Yes, are you getting? Oh my god, the man of DT is here in the class. Rahul sir, very good morning. Rahul sir, you are at present taking which batch? So all the students in the class would know. So we have in the class right now Rahul sir, who also take full English batches. Is that correct, Rahul sir? Are you still there? So, people, by the time we get this reply, English regular and English power for DT. Yes? So, well, we wish if all of you are clear with your second group, then obviously there's no point, although you can refer it to your juniors. However, if there is group 2 yet to be done, then obviously must refer class similar short duration, very impactful batches. The entire fast team actually. Yes, Dhananjay, are you able to connect to what is going on? Dhananjay, I'm seeing you for the first time. Were you not there yesterday? Have you registered for this batch, is it? Should I also see you now? Come on. So people, 22nd as I said was homework. The next question we're going to now start with is question number 25th. Come on, all the live and recorded people, tell me, shall we start? Shall we proceed with question number 25th? Come on, super ultra fast, everyone in the class. Please. Are we all ready? Rahul sir, this is my pleasure that you join in when you are able to manage it. Thank you so much, sir, for joining in. Let's, people, come to question number 25th. What it says, super fast, let's read. We will, as I said, with every lecture proceed with faster speed. Sir, is it that students were not able to receive the email for the live lecture? Wait. चलिए. So I think wait, huh? You have to please wait for a minute. All right. People, so let's proceed ahead super ultra fast, everyone in the class. Sam just declared a dividend of rupees 2 per share. There's this company, Sam Limited, who has declared a dividend of rupees 2 per share and is expected to grow at the rate of 6%. Company will grow at this rate. The dividend is expected to grow at this rate. After paying dividend, the board declared to take up the project by retaining the next 3 annual dividends. The company has declared the dividend for this particular year which has got ended. Now for the future years, company is planning to retain the dividend. So next 3 dividends company won't be able to distribute because it will invest in a project. It is expected that the project is of same risk as existing project. Sir, what is the relevance of this line? Do you people remember I speaking that the required rate of return depends on the risk you take? Higher the risk, higher is the required rate of return. Sir, in this case, everyone please realize, since the new project is of same risk as the existing ones, the risk if is same, obviously the required rate of return will also be same even from the newer project. Alright sir, the result of this project will start coming from 4th year onward from now. Let me again figure out if I have this thing there for you people in my handmade notes. Perfect. Question number 25 is what I'm looking actually. Great. Question number 25. So what they say is that I was being distributing dividend of, I just distributed dividend of 2 rupees, dividend of 2 rupees. For the next 3 years, everyone in the class, I am planning not to distribute any dividend. And dividend then be 2.5 rupee from 4th year. 4th year my dividend will be 2.5 rupee and will grow at the rate of 7% per annum. Where my original dividend growth was people 6%. Yes. Where my original dividend growth was 6%, the newer dividend growth will now be, everyone in the class, 7%. Correct? You are required to figure out whether the market value of share is affected by the decision. Sir, you have to find out before decision what was the value, after decision what is the value, and accordingly if there is any change. Correct? Sir, what is the decision to take up the project by retaining the 3 annual dividends? If we don't take this division, do you agree this dividend of rupee 2 is expected to grow at the rate of 6% forever, where the cost of capital, cost of equity is 8%? So solution, people, before decision, 2 d0 into 1 plus g divided by k minus g. If I try to calculate the value, it is 2 into existing growth rate of 1.06 divided by 0.02. Give me 106 as the price per share. However, if I decide to retain, please imagine it on the timeline. The timeline imagination, as I said, will make the most difficult question easy. Yes? Sir, at 0 point no dividend, second year no dividend, third year no dividend, dividend at the end of 4th year of 2.5 rupee, then forever constant growth rate. At 0 point if you stand where you need to value the share, please tell me this is which model? Gordon's model or variable growth model or anything else? Gordon's model, variable growth model or anything else? Sir, when I stand here, do I have a constant growth rate forever? No. When I stand here, for the next few years, I have 0 growth rate in the dividend, but from 4th year onwards, I have 7% forever growth rate, which means this is a variable growth model. And my main question to you all is, which alternative would you apply? This level of depth, this level of clarity, forget that it can be shared even in the regular batches. Forget power batch. Alternative 1 or 2, what do you all think? Come on. Anuka, you will receive it because the first few lectures are on the YouTube. So we continue to study on the YouTube, and then before the first lecture that we have on the application, the software live, before that you'll receive the link. Are you understanding, please? Come on, think of alternative 1 or 2. Sir, whenever the payout ratio of the company changes on a future date, then you apply alternative 2. Please look at this. Sir, out here, there was some earnings, but it was retained, not distributed. So dividend payout ratio is 0%. Here at the end of second and third year also, there must be some earnings which company planned to retain. Obviously, no dividend distribution, 0% payout. But yeah, from fourth year onward, we see a dividend is getting distributed, which means now it is some payout ratio. So do you agree that my payout ratio is changing from third year to fourth year? And whenever there is a change in payout ratio, what we apply alternative 2? What does alternative 2 say? Alternative 2, everyone in the class says that at the end of fourth year, you stand and see forever constant growth rate. You can calculate terminal value 1 year prior to that, which means I can calculate even TV3, which means I can apply alternative 2. People in the class, how many of you could very clearly connect to the logic that I explained? Please tap the like button to tell me if you could understand this particular point, this level of depth or not. Come on, everyone in the class. People. Tell me, could you connect all to this particular thing? All the live, even the recorded ones here, come on, correct. Sir, for TV3, what do I need? I need D4 divided by K minus G. Has the question directly given to me the D4? The answer is yes. 2.5 is nothing but my D4 divided by K remains 8%, G has become now 7%, and that's how I get TV3. Then I have to discount manually 1, 2, 3, the 3 dividends and the terminal value of third year. These 3 dividends are anyway 0. All I have to discount is the terminal value 2.0. Correct? So sir, what do I do? This is my terminal value at the end of third year. This is present value factor at the rate of 8% for 3 years. And when I multiply it, I get 198.5 rupee. Yes, people? Do you see this happening? Settled are we? Use your calcs. 2.5 divided by 0.01 into 0.794 being the factor, 198.5 everyone. Whenever we do this in the class, you have to simultaneously use your calcs and arrive at the answers. Sir, we can say that due to the decision, the price of the share increased from 106 to 198.5. This was part A. Very quickly, people in the class, part 2. Are we all set? Please respond once in the chat box so that I can proceed to the next one. Come on, come on, come on, come on, everyone. Are we all please 100% set with it? People speak up. Shall we? To the next one. Come on. Sir, recommend how the investor can maintain his target receipt from the investment in the first 3 years and improved income thereafter, given that cost of capital is 8%. Sir, let me first of all read this particular line we missed. It says that an investor has 1,000 shares of the company, wants a receipt of 2,000 per annum from an investment. Sir, initially the company was distributing 2 rupee per share. I had 1,000 shares, so I was getting 2,000 per annum. But now I see that the company plans to retain the next 3 dividends. So how will I be able to maintain my target receipt in the first 3 years? That is what they are asking. The thing is really simple. Sir, let me tell you. First of all, do you agree that company's share price, if the company does not distribute dividend, and I need cash flow, what can I do? I can go to the market, sell my share, generate or receive some amount in the form of cash flow. Correct? So I will have to first of all figure out at the end of first year and second year and third year what are going to be the share prices. Because only if I know those share prices, then only I'll be able to figure out that okay, to realize 2000 rupees, how much can I? To realize 2000 rupees, to generate 2000 rupees, how many shares will I have to sell? Yes. So come on, let's figure it out. Sir, you have to apply common sense. Right now, I calculated the value at this point by discounting all the future cash flows. If someone asks me to calculate the value at this point, do you agree I will have to discount the future cash flows a year lesser? Rather than bringing them to 0 point, I'll have to bring them to 0.1. Similarly, the price at the end of second year will be to further less discounted, basically bring it to 0.2 only, not even 0.1. If I have to discount the cash flows lesser by 1 year, can I otherwise say it? Can I compound it back? I have the value of rupee 198.5 standing here, which is nothing but the value of discounted cash flows. So if I have already discounted them to 0.0, if I need the value at the end of first, second and third year, can I compound it back, people, to find the value at respective year end? Are you finding it absolutely logical? Please respond. So let me compound it back, people. 198.5 is the price. For 1 year, it will be 1.08. For second year, it will be 1.08 to the power 2. If the discounting rate is KE, even the compounding rate will be KE. 198.5 to 1.08 to the power 3. So I'll take 1.08 on my calci into 198.5. Equal is 214.38. Again equal is 231.53. Again equal is 250.05. Can you all please check the prices to be same as this? Now I want to receive 2000 rupee at the end of first year. Every share that I sell will give me 214. Can anyone in the class and the chat box please respond with it? How many shares will I have to sell if I want to receive 2000 rupee and every share give me 214.38? Come on everyone, waiting. Super fast, I'm waiting literally. People. Anuka says it's 10 shares. Come on, other live and recorded people in the class. What do you all say? Sir, 2000 divided by 214.38. 2000 divided by 214.38 is actually 9.33 shares, which turns out to be 10 share on a rounded off basis. Sir, why do we have to do upper rounding off? Because by selling 9 shares, will you be able to generate 2000? No. Only if you sell 10 shares, you will be able to generate 2000 rupees. That's how second year and third year from respective prices, if you divide, you will be able to tell them how can you maintain the target receipt. Not only this, we have to answer to the examiner, we have to also guide them the improved income. Sir, in first year I sold 10 shares, then I sold 9, then I sold 8. Total of 10 plus 9 plus 8, total of 27 share I sold. Out of how many shares I was holding? 1000. So I am yet holding 973 shares with me. Where income per share from fourth year onward will be 2.5, and I can say the improved income thereafter will be 2432.5 rupees. 2432.5 rupees. Everyone, waiting for your responses. Could you connect to question number 25th entirely. How much out of 10 are you people? Please settle with it. Come on. Come on, people waiting. Speak up. Are we all 100% set with it? So that's how 25th question, people in the class, gets done. 26th question doesn't is not very relevant for us. 26th question we don't have to do. 27th is a homework question, is actually marked as pink because it has ambiguity. 27th is homework. 28th is a really good question. A small tricky point it has, which I need to explain in the class right now. Sir, we won't solve the entire question, we just understand it. The question is really easy. It's fine even if you do this question only on your calci, because the presentation is not difficult. That a small point of trick is difficult to understand. So let's proceed. Mr. A is thinking to buy share of 500 each, having a face value of rupee 100. There's this person, Mr. A, who wants to buy share of 500, right? He is expecting a bonus ratio of 1:5 during 4th year. Listen to this carefully. If you have one share, if you buy today, can you please tell me at the end of 4th year how many shares it will become if the bonus ratio is 1:5? Against every 5 share you will get 1 share bonus, which means against every 1 share you will get 0.2 share as bonus. So if you are holding 1 share today, at the end of 4th year you will have 1.2 shares. Yes, am I absolutely making sense? So let us proceed. Sir, annual expected dividend 20%, which means as a percentage of face value dividend rate tells you the amount of dividend, which is 20 rupees. 100 into 20% is 20 rupees. Same is expected to maintain on the expanded capital base. After the bonus is issued, my capital will expand. Even on that expanded capital base, the 20% ratio is expected to remain the same. He intend to sell the share at 7th year, expected price 900 rupees each. Fine. Incidental expense for purchase estimated to be 5%. Sir, when I purchase a share, I have to pay 5% extra, brokerage or any kind of other relevant expenses. He expects a minimum return of 12% per annum. If you buy the share, what is the maximum price you should pay? Sir, what is the maximum price you should pay? So first of all, you realize that the value of a share today, the price that I'm ready to pay today, is the present value of my future cash flows. I want to give you all a time of a minute. You all take a minute. Figure out in your brains, imagine what should be my future cash flows. Imagine which method exactly to be applied, and then we do it together in the class, giving you a minute to think and evolve yourselves. Come on, people. I'll be back in a minute, okay? Have you all please imagined this? Come on, tell me. People in the class. So if I have to imagine the cash flow super ultra fast, we're gonna not solve the entire question, we're gonna just imagine the cash flows. Discounting, you know how to anyways do it, right? Sir, for the next 7 years, I'm planning to hold the bond, after which I'm expecting to sell it for a price of rupee 900 each. First of all, do you all realize it is a case of definite period holding? For a particular number of years, I want to hold it, not indefinitely. Second, which means present value of dividends and sales price will be the value of share today. Now what are my dividends? Sir, my first dividend is 20 rupee. Dividend for next 4 years will be 20. Sorry, next 3 years. 1, 2, 3 will be 20. Now please imagine, rather than holding one share, you will have 1.2 share from 4th year onwards. Everyone in the class, please connect to my thoughts. From 4th year, during 4-year bonus got distributed, assuming a general assumption is that dividend gets distributed at year end. So at the end of 4 year, I will have 1.2 shares. If 1 share dividend is 20 rupee, so 1.2 shares dividend will be 24 rupee. So 4th year, 5th year, 6th year, 7th year dividend is 24. This was still okay for students to imagine. The next thing is where a small trick or maybe a hidden adjustment will student end up forgetting. Now you go to the market to sell the share at a price of 900. You end up forgetting that you are not selling one share, you are selling 1.2 shares actually. Right? So 900 is the price of one share, multiplying it by 1 by 2 gives you the sale price of that entire 1.2 share, and at a price of 0.95 you generate amount because 5% are incidental expenses even related to sales. You sell 100 rupee, what you get is only 95, and that is what I'm trying to say. This is how much you generate. But sir, we have to find the value of one share. Why are you finding the value of 1.2 shares? At a 0 point when you stand, it is only one share. Because sir, I hold one share, which is why I am receiving dividend of 20 for the next 3 years. This one share today will become 1.2 of tomorrow, which is why whatever future cash flow I get from this one share today, I will have to consider in my valuation. So what I say, that these are my future cash flows. Discounted value is this. Now again, institute is asking for the, 1 second, where is the question? Fine. They are asking, should Mr. B, Mr. A buy the share? That is the first question. So what we say? That the price that we have to pay today is 500. Along with the 5% incidental expense, it becomes 525. So what goes out today with everything is 525. Whatever will come in the future, the cash inflow, present value of that is 536. So do you agree? The value of share, think of it as intrinsic value versus CMP decision. Sir, the price that you pay in the market is this 525. The price that the present value of future cash flow intrinsic value is 563, and difference, since CMP is lower, we say the share is undervalued, hence we say we should buy the share. You can think it otherwise as well from the perspective of NPV. Present value of cash outflow is 525. When I invest in a share, my initial outflow is 525. Whatever inflows I will generate, the present value of inflow is 563.68, and the NPV is inflow minus outflow, which is 38.68. Since positive, it is my gain and I should buy the share. Yes. As a student, I could never correlate the concept of valuation with the concept of NPV. When I was once working with ICICI Securities, We were doing the valuation of a company and my boss used the word NPV. As a student, we have been taught the word NPV from capital budgeting perspective, never from the perspective of valuation. Yes. So he used this word NPV and asked like, yeah, why are you using, like, how does NPV relate to the entire discussion on valuation we are doing? So explain to me this particular thing. That what you compare is that you compare CMP with intrinsic value. This is off exam, I'm just sharing on a lighter note. If you understand it well, don't understand it, no problem, it doesn't relate to exam. I learnt it after becoming CA and after clearing level 1. He said this is how you take your valuation decision, right? Yeah. He said similar to the thought of NPV. Why? What you pay today price is your CMP. In the market, if you buy the share, what you have to pay? It's actual market price CMP, present value of cash outflow. What you get from the project, the future cash inflow, present value of those future cash inflow is intrinsic value. Yes, that's the logic behind valuation, correct? And that is what one of the parameters or one of the variables of NPV is. NPV is present value of cash inflow, which is our intrinsic value, minus the present value of cash outflow, which is my CMP, and difference is the NPV. Again, if you all think that this particular discussion have broadened up the concepts you are learning, please don't like this time, because if you like it again you will end up unliking it. You can do nothing. Maybe if you can want, you can put a good comment on this video. Yes, everyone in the class, are we all aligned? People. Then it says what is the maximum price we should pay. So we will be like, maximum that we generate out of this is 563.68. If I pay X rupee, I will end up incurring 1.5x because 5 rupees is the expense related to purchase. If I pay X, it become 1.05x, right, if I spend X. So how much? If maximum I can pay is 563.68. So can I say, along with the incidental expenses and everything, the max I can pay is 563. So how much, people in the class? Along with incidental expense, the max I can pay is 563. So how much is the price? Can I say this 563 is actually equal to 1.05? It is actually equal to the incidental expenses already added up in the price, that is equal to 105% of my price. So if 105% is 563.68, then how much is my 100%? 563.68 divided by 105% is 536.838, which is 536.84 on a rounded off basis. Oh my God, we have another legend in the class. So Amit sir, few minutes back we met Rahul sir here. How are you, sir? So we have everyone in the class. All the students must be wondering, generally in the classes there are students who disturb the teacher. In our class there are teachers who disturb the teachers. It is the friendship effect actually. So we have students, Amit sir, who takes care of CA Inter. I think not even just take care. He is rocking CA Inter FM, CA Inter SM, CA Inter costing. Yes. The one who's the best calls everyone else the best, right? Sir, how are you? How was your Dashara? Everyone, please in the chat box validate, respond. If I could explain the entire question, we didn't solve this one particularly. The objective was to just explain it. That's all we had to do. Come on. Sir says thank you for making concepts clearer. So you're already a ranker, right? Someone who secured a rank, I don't think one would ever need to make his concept further clear. Isn't it? So well, fine. Thank you, sir, very much for coming. Other live people in the class, please tell me, are we all set? Your yes or no will help. I mean, you have to be very specific and speak up. If it is no, I don't mind repeating it 5 more times. But if it is yes, say yes so that I can proceed ahead to the next question. Come on. People. Question number 28. Status. All clear? Anuka, Aksan, everyone else? So alright, moving people to the next discussion. Question number 24 is really a good question. It is a good question, it is a unique question, it makes you learn a very different concept. But given its rare nature, given its rare possibility of being asked in the exam, I'm not saying this may not be asked, but it is a question. I have to teach to you a particular concept for this question which gets applied only to this question. The concept you learn for this question will be of no use anywhere else. So that those efforts at this point, it doesn't make sense to be put in for this particular question because it goes mathematical. You will have to really put in lot of efforts to make this question work. Yes. So being completely transparent, I'm letting you all know that we are avoiding this particular question. Having said that, you will find a QR code. There is a QR code on this question. If you have a hard copy, if you feel that, sir, I have sufficient time to cover it up, you can scan this QR code and watch the video solution of this question. However, if you feel that, sir, I am already short of time, then considering the importance of other questions, this question particularly feels less important. Yes, am I clear? So 29, your choice. From my side, you can also leave it. Not that it won't be asked in the exam. The relative efforts to be made on this question is not worth it. Yep. Question number 30 and 31 relates to something called as H model. Let me explain to you what's going on. Institute has 4 models: constant dividend, constant growth, variable growth and H model. The H model is something for which in the entire history of institute of I think 20 years, which I have tracked, not even a single question was being asked from this model, right? However, the formula is there in the study material, which is why I do teach it to the regular people, and it doesn't even have any single question on H model. So if I take you all, wait, see, if you observe this question 30 and question 31, this is my own creation. Institute doesn't even have a single question in its study material, RTP, MTB, past exam papers, anywhere to ask question on this particular concept. So what I say is that you don't have to cover it again from exam point of view. H model you can skip, right? Rarest nature of being asked in the exam. No questions so far. Done? So now we all move people in the class to the next model, which is cash flow based valuation. First entire category of dividend based valuation model we have done. We are starting with the next one, which is cash flow based valuation. Do we all have the energies to proceed ahead? Come on, everyone in the class, please confirm. And now let me tell you, with every day you will realize that you have the homework questions piling up. Only if you are not solving it on an everyday basis. So make sure every day after the class, whatever homework question which relates to the top topic we have done in the class, you have to solve those questions in the class on that day itself at home. Done? Else the question will get on compiling, get piled up, and at the end you won't be able to do it. And will blame this power batch. Yes, so point is, question solving is more important then understanding concepts. More important doesn't mean concept one can miss. Concept understanding is essential, inevitable for question solving. But important is question solving. Yes? So you all need to make sure you solve the questions which are homework on a real time basis every day at home. We are starting now with cash flow based valuation. Give me a minute, let me have water, then we proceed. Okay? Chalo boss, shall we proceed? Yes everyone? The next category of model, which is cash flow based valuation model. In the first model, which was discount based valuation, dividend based valuation, what did we do? We discounted the future dividends to arrive at the value of share today. Very similarly, this time we have to discount the future cash flows of the company to arrive the value of company today. There's a difference in the perspective. As an investor, I was first thinking that the dividends that I will receive, present value of those dividends will be the value of the share, right? This time I am not thinking from an individual unit's perspective that this is the amount of dividend I will receive. This time I am thinking collectively, holistically, from all the shareholders' perspective, from equity shareholder as a whole perspective. What is my thought? Guys, you'll have to please give me a minute. This is actually unavoidable. Sorry people, it was unavoidable. So when I think about dividend, I think from the perspective of a single shareholder that okay, this is the amount of dividend I will receive, right? But if I have to think from the cash flow based valuation model perspective, I'll have to think from all the shareholders collectively. In fact, sometimes all the capital providers collectively, not just equity but even debt in preference. Yes. In case of dividend discount model, as a shareholder, I was thinking of the dividend actually received to me or actually to be received by me in future. In case of cash flow based valuation model, I don't think of the dividend or cash flows actually received, but I think of the cash flows which are even available to be received, which are there to be received, which is available with the company, that if they want they can distribute to me this entire cash flow. Even if it distributes a lower part is a different thing. If a higher cash flow is available for distribution, I consider that higher available cash flow. Right? So now let me take you all through the terminologies. Sir, there are two cash flows we'll talk about. When, imagine this. This is equity, this is debt. Equity give equity share capital, debt give debt. To the company, company make use of that money, do the operation, generate revenue, make the expenses, has the profit. Of that profit, company distributes the interest to the debt and company distribute dividend to the equity. But that was the profit perspective. Think of the cash flow perspective. Whatever cash that company generates ultimately is to be paid back to the capital provider. Because profit is an accounting thing. In the actual world, the actual amount that you pay to the other party is cash. Yes, profit is never paid. Cash is what is paid. Yes, what I mean to say is that company will distribute cash from its side to the capital provider. Company will say that, okay, this much cash is available from my side which belongs to you people because you gave me the capital, so this entire cash will belong to you. For me, I have already spent the cash which I needed to spend. The rest of it is belonging to you. This cash that company releases from its side, company make available from its side to be distributed to these people, is called as free cash flow to firm. Yes, out of this cash flow, the first claim is of debt. From that cash, interest is needed to be paid to the debt. From that cash, any repayment of the borrowing is needed to be made to the debt. And then we can say rest of the cash will be available to the equity. Equity anyways has the residual claim, right? The cash which belongs only to equity, if from this FCFF, once the claim of the debt has been settled, once debt has been paid whatever cash it was supposed to be, then rest of it will belong to equity, calling it to be FCFE, free cash flow to equity. Are you all please understanding, people in the class? What I mean to say is we need to first of all learn to calculate FCFE and learn to calculate FCFF. Sorry, FCFF and FCFE. Because from the perspective of equity and debt, they will say if I ask them what is the value of the share or value of the company for you, they will say present value of whatever cash flow which is available for us. So the cash flow which is available for both of them is called as FCFF, and the cash flow which is available for equity is called as FCFE. So present value of FCFF and FCFE is the value of equity or the value of entire firm. Yes, we will first learn how do you calculate FCFE, FCFF. Think of cash flow statement, people. In the cash flow statement, what do you start with generally, PAT? So sir, PAT is what I start with. I need to ultimately reach two cash flows. In the PAT, I know depreciation is non-cash, already deducted, I added back. In the cash flow statement, do you also do the working capital adjustment? Yes, sir. I add the working capital. Sorry, I generally deduct the working capital change. Yes. Sir, please imagine, what do you do in the cash flow increase in debtor? Increase in debtor in the cash flow statement is added or deducted? So obviously, increase in debtor shows my amount being blocked in the debtor, it shows deduction. So similarly, debtor and working capital, similar mindset, correct? Working capital is net asset, debtor is an asset. So similarly, increase in working capital should also be deducted. Sir, what if there is a decrease? There is no question in the entire AFM for decrease. So primarily it will be deducted. So from the PAT, I know these are the two non-cash things to be adjusted, and accordingly I get cash profit. Is this cash profit entirely distributable to equity? No. Business will say, for us to sustain, for us to grow, I will need some amount to invest in the capital expenditure. From the profit that I generate, I will have to buy certain machines, replace certain equipments. So I incur capex, capital expenditure, purchase of fixed asset. From this available cash, company incurs capex. Now rest of the rest of the cash, is it available to be distributed to them? The answer is yes. First distribution is made to debt. To the debt, what do you pay? Sir, we pay interest. Do you agree while calculating PAT, interest has already been deducted? To the PAT, the second thing I pay is repayment of the principal amount. So if there is any repayment, I pay to them. If there is any borrowing, I receive from them. And ultimately then I say that now, first I calculated cash profit. Then I deducted the requirement that business has, the requirement of cash that business has. Then I also deduct the cash which will belong to debt, which means interest as well as the repayment of borrowing. Can I say now rest of the profit which is available will all belong to equity because everyone else before that has been paid? Calling it to be the free cash flow to equity. Sir, why is that word free? Because it is freely distributable without any restriction now to equities, the calculation of FCFE. Yes, all the live and recorded people in the class, especially those who have done some kind of AFM batch before this, are you able to connect to my thoughts better? And those who have not done this batch before, are you able to freshly connect to my thoughts? Please respond. Yes. Come on, people in the class, please respond. Everyone. Yes. So this is FCFE, the cash flow that belongs to equity. Now I talk about FCFF, the cash flow that belongs to all of them. Sir, I have to start with the profit number. PAT was the profit that belonged to equity, which is why I started with PAT. But here I need a profit that belongs to everyone. Can I say EBIT is that profit which belongs to everyone? From EBIT, do I deduct interest? No. Because I want to calculate the cash which belongs to everyone, equity and debt both. If I deduct interest, which means interest gets paid to debt, then the profit left will belong not to debt, will belong only to equity. Which means after deducting interest will be left the amount of profit which belongs only to equity, which is why I cannot deduct interest, because I want to calculate the profit or the cash flow that belongs to everyone. So from EBIT, what I deduct is directly the interest. 1 minus T is what it gives to me is no PAT. EBIT into 1 minus T is net operating profit after tax. Do you agree EBIT is operating profit? But that when become after tax, we call it no PAT. So EBIT into 1 minus T is what I start with. I know in that depreciation and working capital change were to non-cash things to be adjusted. Fine. So I got my cash profit which belongs to everyone. Business says this entire profit is not distributable. I need to make some capital expenditure. So after making the capex, business says that this is my business. Who say that okay, I generate cash profit. From that cash profit, I make the capex. Now rest of the funds I don't need for myself. My business requirements are over. Now I give this cash to you. You distribute it to debt, you distribute it to equity, is your matter. So I say, okay, this entire cash given by the business, which is FCFF, is available for free distribution to both of them. Both of them have a right over it, calling it to be FCFF. People, again at this point you all need to validate, are you able to connect to my thoughts or not? Today it seems is Dashera, I mean next day of Dashera, where most of the students is involved in some religious activities, which is why 2-3 students which are regular in the batch are not able to attend today. Shall I proceed? Sir, let us now proceed. I know that ultimately I need to do the present value of future FCFF, future FCFEs. Logical. First step is to calculate those FCF and FCFE. Sir, that is done. The next step is to learn to discount them. Yes, sir, bring them to 0 point. Sir, for discounting, I need a discounting rate. If the cash flow is FCFE, if the cash flow belongs to equity, the rate will be the one which belongs to equity, which is KE, that is already learnt. 3 priorities, CAPM, Gordon's earnings yield. If the cash flow belongs to the entire firm, so the rate should be one which is of everyone, which is K or WACC. K into weight of equity, KD into weight of debt. Main point of learning here is that, sir, about the weights. Should the weights be based on book value or market value? Before that comes one more priority, which is target capital structure ratio. Company says we want to keep the ratio of debt to equity as 2:3. So you should know that debt will be 40%, equity will be 60%. Irrespective of what is the actual debt equity right now, you have to consider the target weights. Then if not available market value, then it of not available book value. Correct? Yes. So KE into weight of equity, KD into weight of debt gives you WACC, and WACC becomes the discounting rate to discount the cash flow. Here KE becomes the discounting rate to discount FCFE. Has anyone in the class ever wondered, sir, what have you written in this blue text? Anywhere in this book, if I use an acronym or an abbreviation, this is marked in blue. For example, in future, whenever I write MV, you should be able to relate its market value. When I write BV, you should be able to relate its book value. Yes? So simple, so easy. Common things, not much abbreviations. Sir, then learning how to do discounting, and you don't have to learn it. Similar to dividend based valuation model, you had zero growth model. Yes, sir. Out there you had D1 divided by KE. Here you have FCFF1 divided by KO or FCFE1 divided by KE. Depending upon it is the value of equity or value of the firm. When you discount FCFE at the rate of K, you get value of equity. When you discount FCFF at the rate of KO, you get value of the firm. The way of discount depend on the pattern of cash flow. If the cash flows are constantly growing, you apply Gordon's formula, FCFE1 divided by KE minus G, FCFF1 divided by KO minus G. Logic is really simple. Cash flow belongs to everyone, rate should be the one that belongs to everyone, which is KO. Now the next is variable growth model. So same logic, terminal value calculation. So value of the firm will be present value of FCFF of first year, second year, till n year, and along with the terminal value of n year. Similarly, FCFE discount, do the present value of FCFE of first year till 10th year and terminal value of nth year. Please tell me. Settled. And now when we discount them, we get the value of the firm. Sir, if we have the value of the firm, from that if you deduct the market value of debt, what we are left with the value of equity? Or if we have the value of equity, if we add up the value of debt, we get the value of the firm. Which means at the end, even these two things are interrelatable. The point is, out of the two methods, which one to apply? Depending on the data given in the question. For example, if PAT is given, you apply FCFE. If EBIT is given, you apply FCFF. Multiple ways to figure it out. Sir, if KE is given FCFE, is KO is given FCFF. These are some ways to figure that out. Yes? This was the entire theory, everyone in the class, of cash flow based valuation model. Will solve some questions and you realize how easy that is. Question number 32. I think you can do. Question 32 is an ambiguous question, at the same time it is homework. I'm here only to explain the ambiguity. For this particular question, I will only explain the ambiguity. Listen to me carefully. Sir, the examiner says that you have the cash flows for the next 5 years. Fine. Which means the life is really easy. You don't have to calculate FCFE, FCFF, they are already given. All you have to do is to discount them. Now, where is the ambiguity? Listen to me. It is estimated that beyond 5th year, cash flow will perpetuate at a constant growth rate of 8%. For 5 years, I have been given the specific cash flow. But after 5 year, cash flow will perpetuate at the constant growth rate of 8%, which means I could sense that this is where I have to calculate the terminal value. Agreed? The perpetual cash flows is estimated to be 10,260 lakhs at the end of 5th year. When I read this line, they say perpetual cash flow estimated to be 10,260 at the end of 5th year. It gives to me a feeling that it is a terminal value, isn't it? First feeling, why? Because the amount is really big. The cash flows were in hundreds and thousands. It is 10,260. Such a big value gives to me a feeling of terminal value. Second, it gives to me a feeling of terminal value because it is at the end of 5th year. So I have the cash flows of 5 year again, and also the TV of 5 life become easy. However, Institute nowhere says it is a present value of cash flow or it is terminal value. It clearly says the perpetual cash flow is 10,260. So you have to interpret the question literally the way it is. 10,260 is the amount of cash flow, not the terminal value, it is the cash flow itself. But sir, for 5th year, I already have a cash flow. This is the actual cash flow of 5th year. 10,260 is the cash flow which is to perpetuate at the rate of 8%, and this cash flow is to be used to calculate the terminal value. This cash flow is actually telling you what are going to be my future cash flows from year 6 and onwards. So what is the use of 10,260? 10,260 is 5th year cash flow. If I add a growth to it, it becomes 6th year cash flow. And to calculate the terminal value at the end of 5th year, I need anyways cash flow of 6th year, right? That is what it is. Because actual cash flow of 5th year is 1170, which is actually there. I don't have any intent of explaining the entire question. I only had intent of explaining this particular line. Now, how does this line fit to the question that you will automatically understand when you solve this question 32 at home? Are you all please understanding? In conclusion, 10,260 is not my terminal value. It is just that cash flow. It is not the present value of cash flows. Please respond if you could understand this particular line or not. People, 32 question, settled or not? Come on, respond. Come on, come on, come on. Set are we all? Shall we proceed? So question number 32 gets done. 33rd question you won't have to do. 34th question is really a good question we do in the class right now. Let us proceed to solve question number 34. Alright, so come on. Mr. Amit is happy with the investment in a company. It is paying good dividend for the last few years. Last year it paid a dividend of rupees 2. Rupees 2 has been paid as dividend. The share is currently trading at 150. He is in the view that if he applies dividend discount model, share is undervalued. Using dividend valuation model, if you value the company, the share seems to be undervalued. As a financial expert, examine his view that dividend discount model represents fair value. On the basis of following information, calculate the value of share. See, one is dividend discount model, as per which if we calculate the value, share seems undervalued, right? So you have to first of all respond that does dividend discount model actually give me a fair value? You must be wondering then what the hell we have done in the last 2 classes. If the dividend discount doesn't give the fair value, then what does? Sir, a better model is always cash flow based valuation model. Why? I will explain. Sir, on the basis of following information, calculate the value of share. What is the information? PAT of the company has been given. Equity capital has been given. Sir, par value, face value 40 is given. Debt ratio of the company has been given. Debt ratio is not same as debt to equity ratio. Sir, if debt is 60, equity is 40. Debt to equity ratio will be 1.5, but debt ratio is 60 divided by the total capital of 60 plus 40, which is 0.6. Debt ratio tells you how much is the debt in the overall capital, 60%. Debt equity ratio tells you how much is debt relative to my equity, 1.5 times. I have been given the debt ratio as 27%, long run growth rate 8%, beta 0.1 risk free rate, RMRF has been given, capex per share given, depreciation per share given, working capital change per share given. They ask you to calculate the value of the share. Sir, they don't specify model. Please apply your common sense. If they have been given capex, depreciation, working capital change, shouldn't the model be one of the two, whether FCFE or FCFF based? Come on, think. Would you apply dividend model here? Given this data, no. Will you apply any other model? We will further learn about them. No. The data specifically has been what you need for FCFF model. Yes. So now everyone in the class, let us proceed to learn. How do you solve this question? Sir, you know that you need 3 things. You need FCFE or FCFF, first thing. So let us first of all decide which model to apply. You have to find the value of share. You have been given PAT. You have the data to calculate KE. Shouldn't we preferably apply FCFE, everyone? Shouldn't we? Dhananjay, kindly don't do this. Yep. People. So please tell me, should we apply FCFE model? All the live and recorded people in the class kindly respond. Super fast. Anuga, Aksa, Atulya, everyone, all other live and recorded people. Surya, come on, those who are sitting. In FCFE model, we need 3 things. First, we need FCFE, then we need KE, and then we need to learn to discount them. Sir, calculation of FCFE, let us proceed. Sir, I need PAT, I need to add back depreciation, I need to deduct working capital, I need to deduct the capex. The point in this question is that since capex, depreciation and working capital have been given on a per share basis, per share, why don't I take my PAT, even the PAT on a per share basis, so that the entire calculation run on a per share basis? Sir, I say that PAT of the company is 290 crores. PAT of the company is 290 crores. Correct? Now you all listen to me. Sir, PAT is 290 crores. Number of share. So basically equity capital is 1300, par value is 40. So 1300 divided by 40 gives me 32.5 crore share. And 290 divided by 32.5 crore share is 8.923. 8.92 being the EPS on a per share basis. So now I know that if I have EPS of the company, I have to add back depreciation given as 39. I have to deduct capex given as 47. I have to deduct the working capital given as 3.45. Sir, how do you know working capital is to be deducted? As I explained, as the company will grow, the working capital requirement will grow. An increase in working capital similar to increase in debtor is considered as a deduction in cash flows. Same logic, right? Sir, 39 depreciation added back, working capital and capex deducted. All this was fine. All this was fine. See, EPS add depreciation minus working capital investment minus capex. The main and the most important adjustment of this question is this hidden adjustment. We could never identify if we don't remember it. As a first timer, we won't be able to ever figure this out at our own unless we remember it and learn it now, the hidden adjustment. What they want to explain is that you want to invest 47 rupees in the company in the form of capex. Please feel this. In the balance sheet side, I want to buy fixed assets for how many rupees? 47. I want to invest in the stock of the company, in the debtors, in the capex, how much? 3.45. So to be able to make these two investments of fixed assets, of debtor inventory in the form of working capital, how much amount in total do I need in hand? 40.45 rupees. This much rupee on a per share basis. Please understand the depth, feel the clarity with which I want to explain the things. 50.45 rupees the investment to be made in the capex and working capital, fresh investment in this year. Please tell me, of this fresh investment to be made, do we have to raise the amount from the capital provider? Answer is not the entire amount. Why? Because sir, depreciation is a non-cash expense. Depreciation gets deducted from the profit. Does it ever go out of company? No. Depreciation is available in the company in the form of cash, right? That profit remains with the company, that has never gone out. It is a non-cash expense, which means equal to the amount of cash, equal to the amount of depreciation, the cash is available with the company. So of the investment of 50.45 rupees to be made, 39 is available cash with the company. So how much is the cash to be raised from the outsider to make these two investments? Only 11.45 is to be raised from the equity and debt, to make these investments. Requesting people in the class your responses, please specifically respond to this point. Could I explain? Come on. Waiting. Recorded people, please respond specifically. How is your understanding? And when you are responding, please do respond how is your understanding so far for everything. Settled. So let us proceed. Sir, what we say now is that, sir, 11.45 is what I need to raise from the parties, additional capital. So can I raise it from anyone? No. I have a fixed capital structure that 27% is to be raised. 27% is to be raised from here and rest of the 63 from equity. So do you agree in the calculation of FCFE, I have to consider the borrowings and the repayments? Because what I borrow from the debt is my inflow, what I repay to them is my outflow. So 11.45 multiplied by 27% is the amount of borrowing. Yes, so let's do it. 11.45 multiplied by 27% is 3.09 on a per share is the amount of borrowing. This is actually a hidden adjustment, people. You have to realize. Give me. Yes, people. Sorry. Today I have something in hand which I cannot avoid, which is why I had to pick up the call. So, anyways, this particular point, yes, this particular point of borrowing, examiner did not anywhere specify if you realize that you have to borrow. Look at the question. Does it anywhere specifically say you have to borrow? It doesn't even use the word borrowing. It is our remembrance for this question that whenever there is a fixed capital structure and whenever the company needs to raise capital, it has to be in this ratio only, which means we would be raising money not only from equity but also from debt. And if you raise money from debt, please observe, raising money from debt or repaying to them is a part of FCFE. For FCFF it doesn't matter, because for FCFF we want to calculate the cash flows which anyways belong to both of them. We don't deduct interest which is paid to them, the borrowing which are repaid to them, because if we pay to them, we are left with the cash will only belong to equity. Then how would I call it FCFF? Which is why I cannot deduct the cash which belongs to them. Before deducting them, I can tell, okay, this is the cash flow which belongs to both of you. Which is why in case of FCFE, payment borrowing comes into picture, and that payment borrowing here was an hidden adjustment which we had to very clearly understand. So come on, now let us calculate FCFE. 8.92 plus 39 minus 3.45 minus 47 plus 3.09, the borrowing gives me 0.56 as my FCFE. If the question is not clear between D0 and D1, we used to assume D1. If the question is not clear whether it is FCFE1 or FCFE0, we always assume FCFE0. Same for FCFF. So this is assumed to be FCFE0. Using beta RF RM, we calculate KE, which turns out to be 8.86. Growth has been specifically given 8%. Sir, let's apply Gordon's model. Rather than D0, you should write FCFE0. So FCFE0 into 1 plus G divided by K minus G. 2 being the, 1 second. How is this? Sorry, I took you to the wrong place. Here it is FCFE0 only. So 0.56 being FCFE0 multiplied by growth rate of 8% gives me FCFE1, divided by KE of 8.86% minus growth of 8% give me the value of share as value of share as 70.325, which is 70.33 rupees as the value of share using FCFE model. Another part of this question, everyone in the class, is the dividend discount model. A basic one you will have to do at your own, and then is the theory which explained to you how is dividend based valuation model is not a perfect model. Why is a cash flow based valuation a better model? A theory you'll have to read. That completes the discussion on question number 34, people. Now we all take a break, post which we come back and proceed to solve question number 35. 35th onwards, we all take it after the break. Everyone, are we all please aligned, superset with whatever we are doing? Please tell me. So let's proceed to take a break now. Let's meet back at 11 a.m. Then we continue. Alright, see you all people after the break. Bye. चलिए public, are you all please back? Come on everyone in the class. Are you all please there? Shall we proceed? So we've had solved before the break one question of FCFE based valuation, where we first calculated FCFE, then we figured out a discounting rate using which the FCFEs are to be discounted, and then we arrived at the value of the equity. We did that discounting, right? People, now in this question, let's start to read what it asks. We proceed? Everyone? So come on, let's understand what it says. Following information is given with respect to WXY Limited, which is expected to grow at the rate of 20% per annum for the next 3 years. For the next 3 years, right, the 20% is going to be the growth rate. Fine. After which it will stabilize at 8% per annum normal level in perpetuity. Then the growth rate forever will be 8%. Fine. Revenue of a company for the year ended 31st March 2014. For the year 2014 which has ended, right, revenues have been 7500, COGS has been 3000, operating expenses are 2250, capital expenditure is 750, depreciation which is already included in this operating expenses 600. First, examiner has given to us the information regarding the income statement, operating expenses, depreciation, capex, everything. First point you all should realize is, sir, operating expense means all kinds of expenses. Meaning to say, it includes COGS, it includes admin, selling, general, everything. But out here if you observe, COGS is 3. So operating has to be logically more than 3 because it includes COGS. And if it is less than 3, can we say by operating expense institute mean to say the other operating expenses other than COGS? This is with the help of this number we could crack. There is no other way to crack it, right? Otherwise we can say that since institute has given these two things differently, then it makes more sense to assume them to be different, not assume one is included in another and so on. Unless they specify that depreciation is included. If they don't specify here, we will assume that depreciation is different, operating expense is different, and COGS is different. Logically, if you see, COGS is also a part of operating expense. Fine. During high growth period, revenue and earnings before interest and tax, meaning to say revenue and EBIT will grow 20% per annum, which means for the next 3 years, revenue grow 20% per annum, EBIT also grow 20% per annum. Fine. Capex net of depreciation will grow at the rate of 15% per annum. What do they mean to say? You add back depreciation, you deduct capex. How much depreciation will get added back? 600. How much capex will be deducted? 750. So net deduction is 150, which is capex net of depreciation. This 150 rupee will grow by 15% for the next 3 years. From year 4 onwards, normal growth period revenue and EBIT will grow 8%. Sir, at the end of third year, till the end of third year, growth will be like 20% and 15%. From the point, I mean to say from third year end and onwards, after the third year end, the growth of EBIT revenue will be 8% and incremental capex will be offset by depreciation, meaning to say what you add on account of depreciation is the same amount what you deduct on account of capex. Both the things will get offset by each other. During both the periods, working capital will be 25% of the revenue. Sir, at any given point, how much working capital remain invested in the business is required by the business? 25% of my revenue. The weighted average cost of capital is 15%, income tax rate will be 30%. Estimate using free cash flow and WACC methodology, whatever is the value of the firm. FCFF and WACC, by using these two things, we have to calculate value of the firm. Is the question clear? When someone asks me to calculate the value of the firm, the first thing I need is WACC, which is given to me. Then I need FCFF, which I will have to calculate. Third thing I have to identify is which model. Zero growth, constant growth, variable growth model. So obviously two different growth rates are there. 3-year different story, after 3 years different story. So it is variable growth rate. I am in a crystal clear manner trying to explain to you in your imagination what all do you need. WACC is given, variable growth model has to be applied, FCFF is to be calculated. My first question to you is, you need FCFF for how many years? Meaning to say, for 1 year. You need FCFF for how many years? Let me tell you. Can you please imagine a variable growth model? There is a point at which I have to calculate terminal value. The point from where growth rate become constant, that's where I calculate terminal value. In our question, it is 3rd year end, after which the growth rate become constant. So I will have to calculate TV3. Which means, do you agree to be able to calculate TV3, I will need FCFF4. And anyways, I would need FCFF1, 2 and 3 as well. So this imagination of where do you calculate terminal value will give you first of all the clarity of how many years you need FCFF. Because we need to do manual discounting of these FCFFs. So you need to do this 4-year calculation of FCFF. First 3 FCFFs will be manually discounted. The 4th year's FCFF will be used to calculate terminal value 3. Now I take you to the next thing. Sir, to be able to calculate FCFF, what do I need? I need EBIT. Okay, sir. Then I need tax rate. Then I need depreciation. Then I need working capital. Then I need capex. Has the EBIT been directly given to us for 0 year? Yes, sir. Revenue minus COGS minus operating expense will give me EBIT of 0. So EBIT you can grow at the rate 20% for the next 3 years. And for the 4th year, you can grow it by 8%. EBIT gets sorted. Depreciation net of capex can also work this way. This net number of 150 that we learnt here will grow at the rate of 15% for the next 3 years, then it will offset. Sir, what about working capital? Working capital requirement is 25% of the revenue. In FCFF, I don't need working capital, I need increase in working capital. There is a difference. Total working capital invested in the business, it doesn't matter to me how much is the change is what matters to me. So I need first the working note of calculating working capital requirement. For how many years? 4 years. If you don't have this terminal value calculation clarity, you won't even realize that I need to prepare a working note of working capital for how many years. Yes? Are you all please able to connect to my thoughts, everyone in the class? So sir, I will say 0 year. My revenue was 7500. How much is 25% of the revenue? 7500 into 25% is 1875. At 0 point, working capital invested was 1875. Then it is 9000 multiplied by 25%, which is 2250. Then it is 10,800 into 25% is 2700. Meaning to say, revenue is growing at the rate of 20%. For last year, it will grow by 8%. 12,960 plus 8% is 13,996.8. Whatever is the revenue of every year, do calculate along with me. 25% of it will be the requirement in the business of the working capital. which means as per this logic 1875 at 0 point is already invested in the business. Next year it should be 2250. So how much is the increase in working capital? 2250 minus 1875 is 375 being the amount of working capital required. 375 is the amount of working capital required in the first year. Similarly, do calculate the amount of working capital required in the second, third and fourth year. Waiting. Whenever you people have done it, you let me know please that. Come on. Do it. Waiting for you all to respond in the chat box. Come on people. Are you people there with me or not? Come on, tell me. Done. So this is how the working capital will get increased in the business, which means it get invested in the business, which means it is needed to be deducted. Sir, first I calculate a bit, super ultra fast. 7500 was the revenue of 0 year minus COGS of 3000. 7500 minus 3000 minus 2250 is 2250 as the EBIT of 0 year. This EBIT has to increase by 20% for the next 3 years. So plus 20% is 2700, plus 20% is 3240, plus 20% is 3888. And the last one will be plus 8%, which is 4199.04. This is the amount of EBIT for next 4 years. From the EBIT, I directly deduct tax at the rate of 30%. So what I'll be left with is the 70% component, which is no PAT. Not making the calculation, directly assuming these numbers to be 70% of these EBIT numbers. Done? Fine. I need to deduct change in working capital. 375, 450, 540 and 259. The working capital change got deducted. Then is everyone in the class capex minus depreciation. At 0 point, it was 150 of net number to be deducted, which has to increase by 15% per annum. So 150 plus 15% is 172.5 plus 15% is 198.38 plus 15% is 288.13. Right? So this is how the deduction of it is. For fourth year, both the things will compensate each other. So that also we understand. Now, all the elements needed for the calculation of FCFF are considered. When you add up, you realize the amount of FCFF for the next 1, 2, 3 and 4 years. Done. For example, let's do it for 1 year. So 2700 into 70% give me 1890 minus 375 minus 172.5 is 1342.5. 1342.5 as my FCFF for first year. Similarly for second, third, fourth year. Now I know that using fourth year FCFF, I need to calculate TB3. And 1, 2, 3 FCFF are to be manually discounted. So 1, 2, 3 cash flows, again 3 for terminal value. Sir, 1342, 1619, 1953. And 2680 divided by KO minus forever growth rate of 8%, KO minus 8%, so 15 minus 8. Yes, so 2680.13 divided by 0.07 is 38,287.57 being the terminal value of third year. Plus I have the cash flow of first 3 years. If I discount them and do the total, the value of the firm turns out to be 28871.01. 28871.01. Question number 35th, everyone in the class we have done. Please respond if you are able to connect to it or not. Come on, everyone. Question 35th, are you able to connect to it or not? Waiting, everyone in the class, for your responses. Please speak up. How much out of 10 are you people please settled with 36th question we have done? 35th question we have done. Please everyone. Really, no compromise in understanding the things, in solving them. But you have to particularly realize one thing. How many of you feel that, sir, in the class there is too much of content to handle? You explain things, you solve question, next explain thing, next solve question. We also talk about minuteness. Those, a lot of small things are there to understand. Do you feel so? Do you know what is the way out of it? What is the way out to get this sorted? It is, people in the class, really simple. One word answer to this problem is revision. The more you revise, the more automatically you will get a comfort over it. Are you all please understanding it? Yes. 35th gets done. 36th is similar nature homework question. 37 is also homework, very easy. 37 is also homework, very easy. 38th we do in the class. A bit tricky, good question, reverse calculation based, super ultra fast right now in the class. Question 38. Come on, all the live people, all the recorded people, we proceed. Shall we? Come on. The valuation of Hensel Limited has been done by an investment analyst. So there is this analyst, your future job profile, who has done the valuation of this company. Based on the expected free cash flow of 54 lakhs for the following year, which means for the coming year, which means for the first year, the cash flows were expected to be 54 lakhs and an expected growth rate of 9%, the analyst has estimated the book value of 1800 lakhs. Based on the cash flow of 54 lakhs, based on the growth rate of 9%, the value of the company has been estimated as 1800 lakhs. Which means, can you do back calculate the KO which was being used? But sir, why do we back calculate it? What is the reason? Let me explain. The analyst has estimated the value to be 1800 lakhs. However, he committed a mistake of using book values of debt and equity. Sir, to calculate value, KO is needed. KO comes as KD, WD, KE, right? While taking this WD and WE, he has committed a mistake of taking book values. Which means, do you agree that if the book values are incorrect, if the weights are incorrect, KO is incorrect and accordingly the value of the company is incorrect. But how do you know, sir, it is incorrect? The book value employed by the analyst are not known. We don't know what were the book values being employed But you know that Hensel Limited has a cost of equity of 20% and cost of debt of 10%. KEKD you know. The value of equity is thrice of its book value, whereas market value of debt is 9 by 10 of the book value. We have been given that whatever is the book value, multiplied by 3 so that you get the market value of equity. And whatever is the book value of debt, multiplied by 9 by 10 so that you get the market value of debt. You have been given the market values of equity and debt. Right? Now what do I want? Sir, I want to calculate the correct value because the mistake was that we had considered book value. Are you learning the flow of the question? I'll take you again to the handmade notes and tell you how simple this thing can be made. Question number 38 is what we have to go to. See this. I have an incorrect value of 1800 lakhs. Right? Which is based on a KO which is incorrect. Because KO was based on a book value which was incorrect. Now I need to rectify those weights to the market value by multiplying it by 3 and 9 by 10. Taking the KE and KD, calculate correct KO and calculate the correct value. If I have the incorrect value of 1800 lakhs, right? So I know that 1800 lakhs was calculated using 54 of FCFF1 divided by KO minus G. Can I calculate the incorrect KO being used? So let's proceed right now. Sir, 54 divided by 1800 plus 0.09 gives me 0.12 KO. The incorrect KO being used was 0.12. Please imagine how would this 0.12 been calculated. It must have been calculated using the weighted average. So cost of equity has been given by the question as 20. Cost of debt has been given 10. And there would be some weights, x and 1 minus x. The weighted average of it is I know 12. So can I back calculate the weights, people? Cost of equity is 20. Weight of equity is WE. Cost of debt is 10. So weight of debt is 1 minus WE. And weighted average I know is 12. Can I calculate the incorrect weights being used? So let's proceed, solve it. Sir, it is 20 WE plus 10 minus 10 WE minus 10. So 12 minus 10 which comes here. If I solve it, it is the 10 which comes here. So I'm left with 2. 2 is equal to 20 WE minus 10 WE which is equal to 10 WE. So 10 W is equal to 2. So W is equal to T divided by 10 which is 20% weight of equity, weight of debt 80%. These weights are incorrect weights. These weights being used of 20 and 80 are incorrect. Examiner asked me to calculate correct value. For that I need to have the correct weights. So it has given to me the hint to calculate correct weights. They say weight of equity is 3 times of book value. So if the weight of equity is 20, out here it should be 60 proportionately. And the weight of debt which is 80 should be 9 by 10 which is 0.72 it should be. So now I have the weights. But please observe a point of difference. Here they were in terms of percentage because the total is 100. Now they are not in percentage. The total is not 100. They are in terms of ratio, proportion. 0.6 is to 0.72 is the proportion in which the weight of equity and debt is. I need to calculate the correct KO, right? I need to calculate the correct KO. I know. Cost of equity into weight of equity will be what? 0.6 being the proportion of equity divided by overall proportion, overall value of debt plus equity is 0.6 plus 0.72. It is as good as if someone say weight of equity is 2 and weight of debt is 3. How much is it in percentage terms? 2 divided by 2 plus 3 which is 40% and 3 divided by 2 plus 3 which is 60%. Are you understanding? 2 divided by 2 plus 3 and 3 divided by 2 plus 3. So similarly 0.6 divided by 0.6 plus 0.72 give me in percentage terms what is the weight, and 0.72 divided by 0.6 plus 0.72 in percentage terms it gives me the weight, correct weight. So 20 is the KE having this weight, 10 is the KD having this weight. So how much is my KO? Sir, 0.6 plus 0.72 is 1.32. So 0.6 divided by 1.32 into 20m plus, and 0.72 divided by 1.32 into 0.1 is into 10m plus. Memory recollect is 14.5454 is 14.55 being the KO. I have now the correct KO. The 54 lakhs FCFF was there, growth of 9% was there. Can I calculate the correct value of the firm? Sir, 54 divided by 14.55 minus 9, which is 54 divided by 5.55 is equal to 972.97 lakhs being the correct value. Could you understand? Really good question. Right from incorrect things, right from incorrect value you calculate incorrect KO, then incorrect weights used to do in that KO. Rectify the weights and re-perform the process, in a normal manner, not in a reverse manner of calculating correct KO and then correct value. That was question number 38. Institute sometime ask a question from study material. Please tell me, could I explain this question to you all or not? People. 38th. Are you all please settled with this or not? Please speak up. Come on. 38th question with all your comfort gets done. 39th you don't have to do. Such a huge question. 39th you don't have to do. 40th is an easy question. You will have to do it at your own. 40th. An extremely easy question you will have to do at your own. Right? Now let me figure out the plan. 41st question is homework, or you may skip. Frankly, 41st question is a less probable question, frankly. So if the time doesn't allow, you may leave. However, if you feel like doing it, you do it. Obviously, there is a difference that we have in terms of coverage. For example, I give to you the same book as I give to you a regular batch student. So in that case, where a student prepares 2 years before the exam, 1 year before the exam, has sufficient time in the batch as well as to prepare at home, we solve as many questions as possible. That time we don't filter out if it is rare or less probable or high probable. At this point where you stand, where for most of you, more than 90% students of you, not more than 3 months are left for the exam. At this point, we have to do those calculations of which one has some probability of being asked. Some question I make you people outright eliminate outright because they are almost very rare, or even if they ask, they are so huge that we won't prefer to solve them in the exam. Those questions have been outright eliminated. 41 is one such question. However, I see some possibility, which is why if you feel like doing it, you may do it at homework. If you don't feel like doing it, you may ignore it. 42, we do it in the class. 43 will be homework, very easy, only on calci question. 43 is very easy, only on calci question. Come on. 42 question we do right now. So, what is this category? What we do now are not exactly the valuation based question. But do you remember me telling that concept of valuation and concept of NPV has now become interlinked in our mind? Now we realize that there's some linkage. So the questions that we have now relates to NPV along with valuation. Fine, which is why this different category. In terms of concepts, we don't have particularly anything where we need to learn. Whatever you have learned in the cash flow based valuation model is sufficient to solve even these questions, right? So come on people, this particular question, question number 42, we take it right now. Messrs. Rowley wants to acquire Messrs. Poly, right? Rowley acquirer, Poly target. Following is the balance sheet of Poly. The target company's balance sheet on 31st March 2020 has been given. Equity capital of rupees 10 per share is 10 lakhs, retained earnings is 3 lakhs, 12% debenture 3 lakhs, creditor other liability 320. Cash 20, debtor is there, inventory, plant machinery is there. Shareholders of Poly will get 1 share of Rowley at current price of 20 for every 2 shares. So if you talk about Poly, it has how many shares? 1 lakh shares. Because 10 is the face value, capital is 10 lakhs, so it must have 1 lakh shares. Against every 2 shares, it will get 1 share of acquirer company, which is Rowley, right? What is the price of share of Rowley? 20. So total 50,000 shares will get delivered to the target company shareholder, where every share is worth 20. Fine. External liabilities are expected to settle at a discount of 20,000. These two are external liabilities, 3 and 320. When we pay them, when we settle them, we will get 20,000 discount and we will have to only pay them 6 lakhs. Fine. Sundry debtor or inventory are expected to realize 2 lakhs. Sir, debtor and inventory which are 250 actually, they will realize us only 2 lakhs. But why would we realize? So question has not specified very clearly that we are going to settle all these assets and liabilities. Question rather has directly given is this realize this realize that, without specifying that we all sell it. This is the main point of catch in this question. Otherwise, we may not be able to understand what is going on. Why would we randomly realize things? Because we are planning to sell them. Yes? So fine, let us proceed. Poly Limited will run as an independent unit, which means Rowley, after being acquiring the Poly, Rowley will make sure that the another company, Poly, continues to remain as an independent unit. But what is left in that company, sir? External liabilities have been settled, debtor inventories has been sold off, cash is anyways cash. Sir, what is left is plant and machinery. Sir, that is what they say. Cash flow after tax expected to be 4 lakhs for the next 6 years. Sir, 4 lakhs per annum is CFAT you will receive from what? From the operations which has only plant and machinery. Sir, disposal value plant machinery will be 150. Sir, after 6 years when you sell off that machine, it will be 150. Correct? No other disposal is left because everything is sold initially only. Require rate of return 14%. Advice, should we acquire a company? Advice, should we acquire? Should we? What is the feasibility of this proposal relates to NPV? Correct? NPV logic is, what is the present value of inflow minus the present value of outflow? will be NPV. Sir, inflow is 4 lakhs per annum plus 150 at the end of 6 year. This is inflow. Sir, let's calculate 4 lakh into annuity factor of 6 year, 150 into the present value factor of 6th year. Let's very quickly calculate the value of the present value of cash inflow. If I add them up, I'll get the annuity as 3.888. So 3.888 multiplied by 4 lakhs M plus, then 1,50,000 into factor of 5th year 0.456 M plus, memory recollect is 1623,600, the present value of inflow. Now let us talk about the present value of outflow. Sir, what I have paid to them is not in terms of cash. As Raleigh Limited, what I have paid to them is not cash, is rather some value being delivered. My purchase consideration is in terms of shares. So 50,000 shares I pay to them, where value per share, my per share value in the market is 20. So 50,000 into 20 is 10 lakh rupees of share consideration I pay to them as my outflow. Second, I have to also settle the liabilities for rupees 6 lakhs, that also gets settled. Which means I have to simply calculate today when I acquire, I pay them. I do all these buying and selling. I have the inflows, I have the outflows. Net how much remain invested from my side in the asset, plant, machinery, that I get to know. Sir, debtor and inventory will collectively realize 2 lakh. Sir, this is an hidden adjustment you have to remember. Even if the company doesn't specify the cash balance realization, you have to assume it. Because you have to assume that cash is anyways realized. So 20,000 cash realized. So I pay to the shareholder 10 lakh. Buy and sell assets and liabilities, sell off assets and liabilities. Net the pocket, from my pocket, the net amount that went out today was 1380. After doing all this buying, selling, acquisition, everything, 1380 went out of my pocket. What I got is 1623 in present value terms. So NPV of this proposal obviously is positive, which is 1623,600 minus 1380 is equal to 243,600 as the NPV of my proposal. Everyone, are you able to please connect? Are you able to please connect that this question was similar to valuation, but with the thought of NPV in it? What do you all say? Settled are you all? Come on, tell me. People waiting for your responses. बताइए. Yes. So question 42 needed for the exam gets done. 43rd is similar nature, easy question. You can consider doing it, or if you want, you can ignore it. 44th is again also a similar nature question, but the reason I would want to ignore is that it is an ambiguous question. The problem with the ambiguous question is that what is logical is different and what has institute done is different. Now when we do logical, we are afraid we won't get marks, and when we have to do institute's question, we are afraid that we have to mug up because it is beyond, it is against your logic. So what is the final way to tackle it now? Sir, if the question is rare nature question, older question, you may ignore it. For example, asked once in May 12, since then has not been asked in any RTP, MTP exam paper. It's not even there in the study material. What do? Ignore. However, if you go back, you'll find some questions which have been recently asked is from the study material, has been repeatedly asked in the RTPs, MTPs, still ambiguous. We'll face such question. You will have to do those questions. But which solution? The one which is logical or the one which is ambiguous by the institute? For the sake of marks, you will have to do the one which is according to the institute, even if incorrect. Which means we'll have to, sir, kind of remember them, yes. Won't be that difficult. If you revise that particular solution, in every revision, if you revise that incorrect one, you will kind of recollect, remember that, okay, this is how we have to do it. Don't particularly remember it. If you revise that incorrect thing, automatically it will be the part of your remembrance. Done? It'll happen. So 44th, you may please ignore. 45th, you may do. 44, you ignore. 45th, you may do. 46th is must do. 46th is must do question. So I think let's also solve the last question for the day, which is question number 46th. Shall we proceed to solve the last question for the day, question number 46? People in the class. Yes. So come on everyone. ABC company is considering a new sales strategy that will be valid for the 4 years. Yes, the last question. I need all your energies to be here for this last question and you'll find it easy. Come on. New sales strategy will be valid for the next 4 years. We want to know the value of strategy. Sir, value of the firm is fine, company is fine, equity is fine. What is the value of your strategy? I'll tell you. Information related to the year which has just ended is available. What information is available? Sales for the company was 20,000. Gross margin was 4,000, 20%. Admin selling 10%, 2,000. Accordingly, PBT is 10%, 2,000. Of which 30% you pay tax. So what is left is 1,400 being PAT. Fixed asset, current assets, equity is 8,000, 4,000, 12,000. Simple balance sheet. Now what? If it adopts the new strategy, sale will grow at the rate of 20% per year for the next 3 years. Sir, here they say valid for 4 years, here they say it will grow for 3 years. What is the point? What is the difference? Right? It is actually an ambiguity kind of. The 4 here is mistake, 3 is actually correct. So sale will grow at the rate of 20% for 3 years. From 4 year onward, cash flow will be stabilized. Sir, if I adopt a strategy, 1 year, 2 year, 3 year cash flows will grow at the rate of 20%. Then cash flow will stabilize, which means then every year the growth rate will be 0%, cash flows will be stable. What if we don't adopt this strategy? What if we don't adopt this strategy? Sir, cash flow will not grow. Cash flow will be stable right from day one only. Which means whatever was the cash flow based on these financial statements will continue to remain the cash flow for rest of its life. Due to strategy, at least we will grow for 3 years. Then we stabilize. And if we don't adopt strategy, we'll continue to grow without growth. We will continue to be stable right from year 0. Fine. Gross margin, asset turnover, capital structure, tax rate, everything remain unchanged. Which means if my margin is 20%, even after growth it will be 20%. Asset turnover ratio remain constant, meaning to say, sir, sales divided by assets will remain constant. Sale grow by 20%, then asset will also grow by 20%, then only the ratio will become constant. Capital structure remains same, all is raised through equity, continue to remain raised through equity, tax rate is fine. Depreciation would be 10% of the fixed asset at the beginning of the year. In the beginning of the year, suppose at 0 point I have depreciation of fixed assets of 8,000, 10% of it will be the depreciation. Fine. Companies target return 15% incremental value due to strategy. Meaning to say, at this point, if I have the stable cash flows, what is the value? However, if I adopt this strategy, 1, 2, 3, 3 year, I grow. Then for rest of the years, I continue to remain stable. What is the value? Please tell me, due to the strategy, has the value increased? Is the incremental value, or is the value of the strategy itself? Is the flow of the question or rhythm of the question clear to all the students? Please tell me. More than solution, I feel it's important to have the understanding of the question, so that solution can come from within rather than mugging it up. Yes, people? So, Aksa, I would highly appreciate that you have figured out that, sir, it is a variable growth model of valuing the company, because in the first 3 years the growth is different and then it becomes forever stable. Good. In this direction, the mindset should be. That's really great. Sir, let's talk about the value of the companies there is no growth, right? Sir, using which approach, FCFE or FCFF? Sir, there is no debt. Whatever is the cash flow is FCFE, will belong to equity. So what do I start with? I start with PAT. Then I add back depreciation. Then I deduct capex. Then I deduct working capital. And that's how will be FCFE. Now let me explain to you the beauty of this question, which you will rarely get to hear. Yes. Someone is asking if we'll get for free the power batch. Yes, older students, which means exam oriented and regular batch students will get power batch for free in both the languages. Right now the English is going on. Somewhere in the first week of November we'll have the Hindi batch. If you are a Hindi student, you may register it over there, you'll get it for free. If you are an English student, you may register it there, you'll get it for free. Done? So back to the point. That is the advantage of the batches, regular and fast track. Because what's getting delivered to you is of worth. Students are paying for it. And what students are paying is already way less than what is its real worth, and you get it for free. Yes. So anyways, sir, what is the point now? Point is that PAT has been given as 1400. Sir, what about depreciation and capex? They will be 0 and 0. Why? Because as I say, sales divided by assets is asset turnover ratio. Yes, sir. If there is 0 growth in sales, every year sale remain the same, then for turnover ratio to be constant, even the asset every year has to be same. Sale doesn't grow, asset doesn't grow, then only the ratio is constant. And if none of them grow, will there be any capex? Will there be any depreciation? Yes, there will be, but they will compensate each other. Imagine that right now I have 8,000 rupee of asset. You at 0 point, you know, at the end of first year it has to be 8,000 again. Why? Because I need to maintain the assets. There is no growth in them. So if the asset depreciate by 800 rupees due to 10% depreciation, the value becomes 7200. Do you agree? You have to make a capex of 800 again to bring back the value to 8,000. The closing value has to be same as opening. So whatever is the amount of depreciation which reduces my assets has to be the value of capex, which can increase it back to the original value, which means, could you understand, depreciation and capex will be equal to each other. In other words, they will offset each other. The depth you are understanding is not even specified in the study material. A study material directly values the number using PAT. But a student through his logic should crack that you are doing in the class, that how can I consider PAT as my FCFE, because there is no depreciation, no capex, meaning to say they are getting offset by each other. All the live and recorded people, could you understand it? Speak up. Then what, sir? since the amount of sale is same every year. If the asset turnover ratio is same, which automatically includes even the current assets, my working capital, do you people agree even the current assets will be same every year? And if the current assets are same, is there any additional increase in the current assets? No, which means even working capital is zero, which is why PAT and FCFE becomes same for a company which doesn't grow. And now then I can say whatever is my PAT will be the FCFE 1400. And since I have a constant cash till perpetuity, present value will be FCFE 1 divided by KE. 1400, which is the PAT of previous year, will be the PAT of next year, divided by KE of 15%, give me the value of the firm, value of the company, 9333.33. However, if there is a 20% increase, first of all identify where would you do the terminal value. Sir, it will be TV3. Because next 3 years it will be 20% growth, then it will be 0% growth forever. Which means at this point we calculate TV3, which means we need FCFE 4. Which means we need to calculate FCFE for 4 years, which means all the working capital and every working note of capex depreciation for 4 years. This is the clarity with which I want to make you people imagine the solution and then do it. Sir, let's do working capital. Revenue of 0 year was 4,000. Working capital of 0 year was 4,000. As the revenue grow 20%, working capital grow 20% for the next 3 years, 2020. And then in the 4th year, there is no growth. Working capital of 3rd and 4th will be same. So investment in the working capital for the first 3 years will be 800, which is 4800 minus 4000 being 800. Then 5760 minus 4800 is 960. So as the sale increased by 20%, my current asset increased by 20%, and then we calculated the working capital requirement of 3 years. 4th year will have 0 working capital investment. People in the class, till this particular point, I need to understand a validation from you. Are you all literally set with this working note and everything we have discussed so far in this question? Then only I take you ahead. Come on. Please respond to me. Please respond to me. Everyone. What do you all think? Yes? So, everyone in the class, let me give you a clarity. Those students who have already done some classes are coming here with an expectation that I already know everything and I'm here just to revise, may also find these things difficult. Why? Because what I'm consistently doing is to give to you the best conceptual clarity. Now imagine that previously, if you didn't have this clarity of why is PAT and FCFE the same, or any other clarity like alternative 1 or 2, it is new content, new thing for you to learn. In which case you all might feel that okay, it is becoming troublesome, it doesn't look like just a revision, which may be effortful, but let me tell you, fruitful and worth it as well. Because there's no harm in learning new things, and especially the things which are needed for exam. You are raising the bar of your learning, which is why you may find it effortful, but it is worth it. Had your previous learnings been of this level, you might have never faced it effortful, found it new. But now if it is, you are getting yourself exam ready. Done. Where we not only talk about a particular solution, we also try to think in our brains before starting the solution. We try to learn to imagine the solutions, so that if there is a new question, you can run in your, it can run in your brain in a similar way. That okay, I need TV3 means FCFF 4, which means I need to make the calculation for 4 years, which means all my working notes has to go for 4 years. These detailings will have to be processed. If you really want to prepare up to the mark, if you want to make yourself a commitment that 80 plus is possible, then these are the efforts you'll have to make. Not just in the class, same level of efforts at home by solving everything in the notebook, by writing them down. If you don't write, please don't come back to me with an expectation that sir, I also want to score 80 plus. Please don't come back to me. Writing the things will do miracles. Why are we not doing those miracles in the class? Because in 75 hours we want to learn those things which has been taught in those 200 hours. Yes? So back to the point, now working note for 4 years regarding the fixed assets. The opening value of the fixed asset is 8,000. I know depreciation will be 10%, which means, do you agree now the value I'm left with is 7200? Where I know the closing asset has to be 20% more than the opening asset because there's a growth of 20%. So closing asset should be 8,000 plus 20%, 9600. So please tell me, after debt, before capex, the asset is 7200, which has to be 9600. How much is the amount of investment for the first year? It will be 2400. So 9600, the closing value of first year become the opening of next. Depreciation become 10%, 960. So value after debt is 9600 minus 10% is 8640 after debt. Whereas the closing, actual final closing should be 9600 plus 20%, which is 11520. How much do I need to invest to make my 8640 as 11520? Sir, the answer turns out to be 2880. Similarly, for third year, it is 3456. For last year, it is interesting. Fourth year opening is this. Fourth year closing is also this. No growth. Whatever is the amount of depreciation become the amount of capex because I just want to maintain the level of my assets. The value which got reduced by way of depreciation, the same value got increased by way of capex. I have the depreciation of 4 year, I have the capex of 4 year, I have the working capital requirement of 4 year. What else you need? Nothing. Start with PAT, right? PAT, which is 1400, will grow by 20% for the next 3 years. So 1400 plus 20% is 1680 plus 20% is 2016 plus 20% is 2419, and same for fourth year. Depreciation, capex, working capital, from the working note you get FCFE of 720, 864, 1036 and 2419. These three numbers positive, this one. These three numbers negative, this one positive. First three numbers are to be manually discounted. The fourth one is to be used to calculate TV3. Now at the end of 4 year when I stand and I know forever I have the same cash flow, what is the value of all those future cash flow right from 4 year till infinity, at the end of third year, what is the value? TV3. Sir, 2419 divided by KE. No growth, only divided by KE. I get the terminal value as this. I have the few present value factors. The value turns out to be 8650. The value earlier was 9333. The value now is 8650. We say the incremental value of the strategy is negative. This strategy is not financially viable. It's not worth it. People in the class, could you understand and connect to what is going on? Please tell me. We are avoiding those calculations which we have done multiple times, like simply calculating terminal value or doing the present value of these future cash flows. Pointless. The more we focus on, the more we save time, the more we focus on understanding the things rather than just solving it on the calculator, where the things are very easy in a flow. Take your time, do solve it, process it, and let me know how much out of 10 are you people settled with this entire question, with this entire category and the entire lecture we have done in the class today. Take your time, process it, then tell me. Come on. Done. So yes, that was all from my side for the day, and with this lecture we are also done with the cash flow based valuation model, right? Two bigger in size model, dividend discount and cash flow models have been done. Now what we gonna start with the relatively smaller model from the next lecture onwards. The next lecture everyone in the class is going to be tomorrow, which is on YouTube, and then the lecture will be on the application. Which means by the end of Saturday, all of you are going to receive whatever software, serial keys, everything, Google Drive link and everything, in which case you will have to first install, and then we will do a trial run of that on Monday. Cool. For rest of the communication, stay updated to the Telegram channel, which is where I will update if there is any change. Cool. So that was all. Everyone in the class, thank you so much for watching up this lecture. I'll see you again. Take care. I would again request, if you're watching this, if you're liking this, do like it. If you find it really worthful, put up that in the comments. Alright. So take care. Everyone in the class, see you all. Bye. Bye all the live people. Bye all the recorded people. Thank you so much.